Fear, nervousness, excitement, anxiety, overconfidence, greed. Are these terms sound familiar to you but still wondering how to include them in your decision making process? Well, stay in this video as we'll discuss about investor sentiment and how to apply these learnings for a better investment decisions. Hello everyone, I am Vinod Prajapati. In this video, we'll explore if now is a good time to invest based on current sentiments. Just to explain the concept, I am giving you two scenarios. One, everyone is very optimistic about the future, and second, everyone is very skeptical about the future. Now, answer me whether you'll choose to invest in scenario 1 or scenario 2. Many of us say that scenario 1 is a better time to invest our money. But here is a catch. Because the stock market works on a future expectation and is always forward looking, near-term optimism gets priced in faster than we can think of, and then we invest at higher levels with huge expectations, which leads to a negative return or lower than the average equity market return. Let's look at the empirical data and learn about it. RBI publishes consumer confidence survey result on a bi-monthly basis. The survey obtains current perception and 1 year ahead expectation on the general economic situation, employment scenario, overall price situation, and our own income and spendings. This graph represents the RBI's Consumer Confidence Survey result from June 2011 till February 2023. Because many of us feel comfortable investing in an optimistic economic scenario, let us see what would have been our return immediately after 12 months from the periods of extreme optimism. Except in one period, that is January 2017 till January 2018, we would have made a negative return or a lower single-digit return. And had we been a contrarian investor, and had we invested during the periods of extreme pessimism, well, we would have earned more than an average equity market return, and most of the times. At present, the future expectation index level is around its average. In January 2021, investor sentiment index level was around its average. And at that time, equity market in India generated a 26% return in the next 12 months. But remember that the perception of the current situation was very bad then, which is not the case now. So what do you think the next 12 months return would be? Do let us know your thoughts in the comment. A similar index for the US equity market performance and consumer sentiment is available for a reasonably long period. If we look at the periods of extreme optimism, the next 12 months equity market return have been either negative or in a lower single digit. The average return subsequent to 8 sentiment peaks have been just 4.1%. On the other hand, equity market returns after the period of extreme pessimism have been abnormally high. You may have noticed that the average return subsequent to 8 sentiment troughs have been 24.9%. At present, investor confidence is around 65 level against the average index level of 85. Do you think it's a good idea to invest a portion of our investments in US equity market? Do let us know in the comment. Let me warn you that identifying extreme optimism and pessimism is going to be very tough, just like identifying the tops and the bottoms of equity market. So a practical way of implementing today's learning in our investment decision would be that when we see that the investor's confidence index fall below the average, we start investing in equities through SIP or gradually increase allocation to equities in our portfolio through systematic approach. If you know or can think of any other practical way of including investor sentiment index in the investment decision making process, do let us know in the comment.